Hi, I'm Keith McCullough. Welcome back to Tweet Keith. This is where we take all your questions and try to take the top three here on your Market Friday. A bunch of great questions, and again, thanks for sending them in. We'll start with the first one from UPEH Financial. The VIX is finding no love. What triggers a volatility bid, Keith? So this is a real interesting question because we got asked the question actually when the market was up on the day. It was up, remember, this morning on a jobs report that wasn't very good, but whoever was saying it was good, I guess thought it was good. Obviously, it wasn't good. But volatility now is starting to rise as we go throughout the market day. Now, the three main triggers for rising volatility would be as follows. Number one, the front month of volatility, front month VIX, starts to make a series of higher lows. Now, that is real sneaky, but again, it's easy to monitor. I love that one. The next one is a widening risk range. So widening risk range on the S&P 500 in particular. What I do on this is I look at it across durations, but again, the key one is the 3-day duration. So as it widens, what it does is it opens up the downside in terms of an actual probability in the model. So again, I got higher lows and a widening envelope of downside. And then finally, you get the swoosh. So you get a down move, and then all of a sudden people have to sell, and there you got it. You get a rip in volatility. So watch that key trend line of resistance for the VIX on the front month for us is 1472. A breakout above 1472, and the VIX could easily go to 18. Now, the next question from Jorge. Jorge asks, will the tech bubble be as devastating as in 2000, or is it different this time, like MSM, mainstream media, keeps spewing? Now, you know I love that word, Jorge, the spew. I don't love mainstream media when they start to characterize it as this time is different. Of course, that's ridiculous. So again, if you really look at the construct of bubbles in terms of how we look at them, number one, they have to be making higher highs. So again, the price has to keep confirming that indeed it's a bubble. Number two, it has to be a damn good story. It has to just get you fired up like this could never end. And then finally, you have to have MSM, mainstream media, confirming that it can never go down. So check, check, check. We have all three of those things happening until you don't. Then all of a sudden what happened in the middle of March is that the social media bubble stocks, basically, as we refer to them affectionately, of course, they start to break down. No more higher highs. Now we're breaking down through trend lines in names that we don't like. The story starts to get shaky, and then the story starts to have to be reflected upon by the mainstream media. So look at a stock like Yelp. We don't like Yelp because, again, we think that the media loves it for the reasons that they shouldn't love it. We think the addressable market is much smaller than what the company is articulating. And again, now the stock's breaking down. So the mainstream media has to change the narrative. And again, that's how bubbles start to pop and drop. No, this time it's not different. And finally, from Steve Blake, this is a question on economic growth. At the end of the day, will we see sustained economic growth? When? Next week? Next month? 5 years? Well, Steve, at the end of the day, you're not going to see economic growth unless you see, number one, a strong and strengthening currency. So again, this is what we had last year. A strong dollar into June and July. It was pressing higher. It gave us a great opportunity, a great beacon of hope. You know, the purchasing power of the people, God forbid that we actually have that. And rising interest rates. There has never been a sustained economic cycle in the United States of America without those two things occurring at the same time. And again, it's not my opinion. This is history. Clinton and Reagan, 1983 to 89, 1993 to 1999, the dollar was up, interest rates were up, people were getting out of bonds, and commodities got hammered. Now, wouldn't you love that as a tax cut at the pump this weekend, Steve? I indeed would. So those are your top three questions. Thanks a bunch for them. If you have any questions above and beyond that, I'm at Keith McCullough. That's my Twitter handle.